Hello and welcome to Business Today Television. I am Siddharth Zarabi and with me today is Neelkanth Mishra, the Chief Economist at Axis Bank and Head of Global Research at Axis Capital. Welcome to the show, Neelkanth. We are going to focus during this conversation on your latest research report on the economic outlook for India as well as for the globe. And I'm going to begin by getting you to tell our viewers about what we should be expecting as far as India's economic performance in 2025 is concerned.
No, thank you, Siddharth, for having me here. Always a pleasure talking to you. See, the big question mark for 2025 in everyone's mind is will the growth slowdown that we have seen in the first half of this fiscal year, from April to September, will this persist? How much of this is a structural problem? How much of this is because of cyclical issues? We believe that almost all of this slowdown is because of cyclical issues. I think the trend growth remains at about 7%. What happened in the first 6 months of this year is an incredibly tight fiscal condition, meaning that generally in the first 6 months, the central government incurs about 62% of its full year fiscal deficit. This year, it incurred only 29%. So there was a 33% of fiscal deficit, which normally would have been incurred but was not. And as you know, fiscal tightening is very bad for growth. 33% of 4.9% of GDP, which is the target fiscal deficit for this year, means that 1.6% of GDP worth of fiscal consolidation was squeezed into just 6 months. Most of it, almost all of it, was unintended. And we expect that in October itself, we have seen the central government resume spending in a very big way. We expect that as the government catches up and meets its fiscal deficit target for the year, the tailwinds from that should support the economy in FY26. There was a second driver of the cyclical slowdown, which was the problem with the credit impulse. So as we have seen, 17% credit growth has now fallen to below 11%. Some of this was intended. The RBI was very rightly concerned about unsecured personal loans and microfinance loans being too high. But in the process, I think the credit growth has become, or the credit slowdown has become much more broad-based. So if in any economy, credit growth slows from 17% to less than 11%, the economy is bound to slow down. On this as well, we expect that some corrective measures are underway. So what we are seeing now is that the CRR has been cut. I think the 1.16 trillion rupees of liquidity that it brings in, once you apply the money multiplier as well, it will add 5.5 trillion rupees to overall liquidity and can support a 3.5% growth in overall credit formation. So we expect that as the year progresses, we should see a steady improvement in the economic momentum, and FY26 should be closer to 7% real growth.
Okay, so FY26 closer to 7% real growth. I want to come back to the first part of your answer, which relates to government spending. With all the data that you have analyzed, do you see any particular sectors doing well as far as this part of government spending is concerned? And we all know that capex has been one of the key drivers for several years as far as India's economic growth is concerned. What is really enabling this aggressive intent, as you seem to indicate, from the government?
See, there's no aggressive intent. What we have just seen is that because of the elections, the file movement had slowed down. If you recall, elections this year were 1 month later than usual. So while in any election year, there is some disruption to government functioning, this year it was much more delayed, meaning or much longer. So the biggest slippage versus normal fiscal spending actually occurred in May and June. And because this was kind of the pattern of government action was very different. So all we are saying and what we expect to see, and this is what the government commentary suggests as well, is that the full year fiscal deficit target will be met, which means that what was a 1.6% point of GDP worth of unintended fiscal consolidation in the first half could actually be reversed in the second half, and which could actually become a tailwind for the rest of the economy. The nature of spending itself is, I think, much more impactful over the medium term. From in theoretical macroeconomics, the first step is the spending happening or not? What is the level of the fiscal deficit? If the quality of expenditure is much better, in the sense that it is more capex and less revex, the more capital expenditure and less revenue expenditure, the multiplier effect of that in subsequent years is much better. But for this year, at least from my perspective, it would be enough for the economic momentum to pick up if the government was just to meet its spending targets.
Okay, that's a fair point. There's, of course, also a larger debate around revenue expenditure and all the subsidies that are being provided. I wonder if you've applied your mind to the prospects of a scenario which is well into the future. I must point that out, and not something that will happen immediately. This is a one nation, one election. Is there a possibility that this could have some amount of impact? Because we know what happens not just for the center but also states where spending slows down during the election cycle.
So the committee that analyzed the one nation, one election issue, and it was chaired by the former president, they had put out some papers on, or at least one paper I see, on the impact on GDP. And their estimate was quite substantial. But having seen the government from up close in some of the roles that I play, I can sense that around election time, the disruption to government functioning is quite substantial. And it is not just about the fact that there is a code of conduct period where files don't move, no political decisions can be taken. It's also the preparation. So the fact that voter lists need to be cleaned up, the fact that a lot of the government functionaries, either in education or say Aadhaar enrollment, or so there are various departments which then are roped in to conduct those administrative things. And so we have seen from a wide variety of things. For example, child enrollment in Aadhaar. I saw that in some of the more developed states, which generally perform reasonably well on this, there was a significant slippage in the year before the election. And when I asked why that was happening, I was told that the state government employees were deployed into cleaning up the voter IDs and the voting sheets. So I think the disruption to government functioning during elections is quite meaningful. And combining them into one election and making it more efficient, it actually should be helping the economy.
Absolutely, we'll have to wait for that to pan out. Let me now turn to the second part of your earlier answer, which is about monetary policy. Do you think that what happened was a bit excessive in retrospect, and with a new governor manning the mantle at the Reserve Bank of India, do you expect a new rate policy, possibly a cut, and if so, when?
See, on the interest rate side, frankly, I don't think the MPC, the Monetary Policy Committee, has much room for maneuver. In fact, what we also highlight in our report is that we expect inflation to remain elevated for much of FY26, and therefore the MPC may not be able to cut rates. Remember that food inflation has been surprising steadily on the upside, and there are many factors which I think are at play. The first is that the income transfer schemes, which now 14 Indian states are running, are in total about 2 trillion rupees, 2 lakh crores a year at an annualized rate. And given that they are targeted at the bottom 40% of the population, give or take, the impact is the biggest on the demand for food. And so be it potatoes, tomatoes, onions, and you will see that as in the household consumption expenditure survey, as you go up the deciles, the volume of consumption per month keeps going up. Now, when you see this level of a stimulus targeted at the bottom 40%, I think from a medium-term perspective, it is phenomenal if they're spending this on better quality food. But what it does do is it disrupts the demand curve, and then supply is racing to catch up. I expect more states will announce it as in the next 1.5 years, and therefore the demand will remain elevated, far higher than what supply can be. There is a second element to this. If you recall, the introduction of Narega and how it had changed the bargaining power of labor and caused a reset in labor prices. Narega in any given year is 80,000 to 1 lakh crores, depending on the demand. This already is 2 lakh crores, and by the time most of the states are done with it, I think it will be closer to 3 lakh crores. So the impact on low-end wage rates, which actually then feed into labor-intensive crops like vegetables, can also be quite meaningful. So I think the interest rate environment is unlikely to change much. There may not be enough scope. There wasn't enough scope, and I don't think there will be enough scope for rate cuts to happen. Where I think the challenges emerged was on the quantitative side. So there is a cost of money, which is the interest rate, and there is a quantity of money. I mean, how much money are we dealing with? And for nearly 1.5 years, the central bank's injection of money into the economy was well below normal. And a very large part of the money creation was being done by the commercial banks. And as a result, credit growth was way higher than deposit growth. Beginning of this fiscal year, the central bank started becoming uncomfortable that the loan deposit ratios in many of these banks had become very high. And they instructed the banks to bring it down. And as that happened, it actually triggered a downward spiral. So what ended up happening was, because as you know, when loans are given, deposits are created. And so that kind of, I think that has also contributed to the very sharp slowdown in credit growth. That process, I think, with the cut in the CRR is starting to get reversed because then there is a structural change in the money available for banks to lend over a period of time. The RBI also, starting July, had started keeping the overnight money market, or the overnight liquidity in surplus. Currently, there has been a bit of stress because of the currency interventions, but once the CRR effects are fully in play after 28 December, the expectation is that some of those things should start to ease. So once the banks realize that there is less competition for deposits and that they are not going to get slapped on the wrist for growing their loans, the credit impulse in the economy is positive from being very strongly negative. So that's the argument I was trying to make.
Well, that's a sharp argument, and I want to pick on that particularly one aspect, and this is with respect to the future of our monetary policy, given the fact that you make this very important point that there are 14 states and many more, and that amount of spending will only increase and possibly never going to get rolled back. Does this have implications for the manner in which we set our interest rates and the mandate that is given to the Monetary Policy Committee? I also want to bring up here and refer to previous arguments that have been had, and perhaps you've also dealt with them, which is to carve out food prices from the overall inflation basket when setting rates.
See, that at this stage is a somewhat theoretical argument. See, there is a law which states that the MPC needs to target headline inflation. And unless that law is amended, the discussions around this are completely academic in nature. They do not really have much of a bearing in policy. On whether the choice of headline was appropriate, should it have been core? In our report, we publish a very interesting chart, which is the index of food prices and the index of core prices from January 11 to October of this year. And what's very clear is that from 100, if food prices have gone to 220, core has gone to 215. So while in the near term, these may diverge, over the medium term, they tend to converge. And there are many economic reasons why why that can happen. And the point being that from a medium term perspective, perhaps it may not make that much difference. But that's a very different debate, and may not be, all those details may not be very interesting. The bigger question is that the impulse on the inflation side, because of these income transfer schemes, at an aggregate level may not be as intense or as large as what we saw in the 2011 to 13 period, because these schemes are being funded through expenditure switching. So the question to ask from a macroeconomic perspective is, where is these 2 lakh crores coming from? Is it coming from higher taxes? Is it coming from higher deficits? Or is it coming from cutting expenditure somewhere and spending it on these elements? And at least, see, this trend varies from state to state, but at an aggregate level, it does seem to us, and we published on this as well, that the expenditure to GDP, if you compare FY19 to FY25 budget, is not really going up in most of these states. And which means that they are cutting some other expenditure to finance these schemes. And I think the underlying reason is very strong, which is that state governments have a 3% of GSDP cap, which the central government enforces through Article 293 of the Constitution. And therefore, it is very difficult for the state governments to breach that 3% threshold. Hence the aggregate inflationary impact, which is why, an 8%, 10% kind of inflation that we saw for quite a while, 10, 12 years back, is unlikely to happen.
That's a good explanation for this particular question. One more quick point before we move on to discussing the global part of the outlook, and this is with respect to your earlier comment, the CRR cut that we have seen. Do you expect quantitative easing to continue, and how long and to what extent?
See, too much is also not warranted, meaning that the economy should have, or at least the money creating levers in the economy should be unrestrained, but active injection of liquidity at this stage, other than to counter whatever is happening on the FX side, the foreign currency side, may not be necessary. So let me explain that. See, the economic theory says, or financial theory says, that you cannot manage both the cost of money and the quantity of money to the last mile or the last point in together. Meaning that both are interconnected, and there are is called that money supply is endogenous, meaning the economy kind of creates its own money. So, for example, as people demand more credit and banks give that credit, money is created. Overnight money market, when credit growth is strong, things go into deficit. The central bank makes available the money. So in a way, there is a demand angle here as well. So you cannot try to control both at the same time. But at the same time, you need to be conscious that the central bank injection of money, if it is not happening adequately, what levers can be changed? And in my view, I think CRR at 4.5 was because till 2022, the CRR was at 4%, and I think the economy was creating sufficient money. And I think 2022, when liquidity went into surplus, the central bank had raised it to 4.5. Perhaps bringing it down was necessary, and now it has happened. This possibly should suffice. What may be necessary from the central bank is that as they intervene in the currency market, when they sell dollars and buy rupees, they are tightening liquidity. And once the CRR cuts are in place, maybe in say 4 to 8 weeks, if the liquidity remains in deficit and the things in the overnight market are still very tight, they may need to do open market operations to inject more liquidity. But I wouldn't call it quantitative easing. I mean, I would just, we called it, when we wrote about this in August, we called it the end of India's quantitative tightening. So we were, unlike in an economy like the US, which is growing at 4-5% in nominal terms, where quantitative tightening means that you reduce the money supply. In India, where the economy is growing in double digits, the fact that money injection was not happening from the central bank was actually quantitative tightening. So this is the end of quantitative tightening rather than start of quantitative easing.
What's the outlook for the rupee?
One recommendation, which I think is something that a lot of people are making as well, is that the rupee should be allowed to be more volatile. So it has, over the last 2 years, been the least volatile currency in the world. There is some merit in having higher volatility. Having excessive volatility is very damaging for the economy, because there are many economic participants, small businesses, individuals, small investors, who do not have the ability to forecast currency levels, global economy, and therefore may end up paying too high a price for hedging their exposures, either with their importers or exporters. But if you have too little, then the central bank is taking over the responsibility of hedging effectively for the overall economy, which generally is not wise. And especially as we head into a period of significant volatility in currencies globally, it makes sense for the band in which the USD INR moves to be a bit wider, maybe a lot wider than what it has been in the last 2 years. So that argument, I think, is a very straightforward one. And my sense is the central bank may also be looking at what is happening to the currency of late. It may be allowing for that to happen. On the level of the currency, one last point, that on the level of the currency, there have been some exceptional outflows in the last 2.5 months, which are unlikely to repeat, in my view, or not be that intense in the next 3 months. So there has been a significant amount of dollar selling by the RBI to protect the rupee from significant depreciation. So let's see what those factors have been. So there was $11 billion of FPI outflows just in the month of October. Since middle of September, that number would be, maybe double that, maybe slightly less than double that. On top of that, we saw, as you saw from the trade deficit in November, there was a $10 billion of extra gold import that ended up happening. In the month of October, there was some extra $5 billion of oil import that ended up happening. We have also seen several large IPOs where foreign promoters or venture capitalists have sold stake and they've taken dollars out. On top of that, because the rupee was not moving against the dollar or not moving much, several hedge funds have been shorting the currency as well. So all in all, there has been this build-up, and therefore the RBI has to intervene a lot more than perhaps it needs to. In the next 3 months, seasonally, the demand, or at least the balance of payments improves, so the drops, and therefore it should be possible. And then these hedge funds, which were anticipating that the rupee would fall by a lot and they're supposed to cover their shorts, should also be supportive. So in general, the bigger call for the Reserve Bank and for policymakers in general is that if the US dollar appreciates, given that 20th January is the inauguration of President Trump, if among his first policies is the extension of tax cuts, the fiscal deficit in the US starts going up, you have then an increase in 10-year bond yields in the US, more outflows from emerging markets, the dollar strengthens further, and then the rupee can see some more pressure. A bigger issue is going to be what happens to the Chinese yuan, the renminbi. The Chinese policymakers, through allowing the People's Bank of China to buy government bonds, which was not permitted till a few months back, but now it's permitted, by changing their policy to moderately loose, they have already signaled that they are preparing the ecosystem for a devaluation of the RMB. Now, if the USD CNY, which is the exchange rate for the renminbi, was to rise further, I mean, say 7.7, 7.8, then there would be a big question for the Indian central bank as to, do you really want the rupee to be appreciating against the yuan? And this is not just the Indian rupee, because every central bank in the world, especially in Asia, will have to really ask themselves that question: do we want to? So those are the big question marks for the rupee. I must say though that keeping the rupee more volatile should be the stance of the central bank, because it is quite possible that if the Trump policies really go through, meaning that because one of the policies is also to allow a sharp increase in the amount of oil drilling. So suppose US oil output goes up a lot, and say the Chinese economy does weaken further from here, it is quite possible that oil falls to say $60. Now, in which case India, the balance of payments actually improves quite a bit. So there are many variables over the next year or so. So it would be unwise to think that the rupee will keep depreciating. But I think allowing it to be more volatile is, I think, the right option.
Since we moved into discussing the global situation, particularly the United States, there's a question that you have yourself asked and answered in this report, which is, will the new Trump administration's initial salvos hurt or help growth? Do answer that for our audience here.
So there are some steps. See, okay, there have been a lot of political pronouncements, and as now some of the Trump opponents have started flagging, that it seems that he's kind of backing off on some of them already. So some of his public pronouncements on what he plans to do in geopolitics, on how he wants to go about tackling immigration, how he wants to deal with his neighbors, all of those things. I think the starting point was a big promise. So there is some uncertainty on what exactly he will do, what exactly he'll be allowed to do, because there are checks and balances on the US president's actions as well. But what is clear is that his mandate, and I think he will respect that mandate, because he's seen the rewards from honoring, respecting what he's promised to the voters. The first is that there will be checks on immigration. And I think the deportation that he has promised, deporting 11 million illegal immigrants, looks very difficult. It is logistically very difficult. The largest number of immigrants the US has ever deported in 1 year is 0.5 million, because it takes time to identify them, detain them, go through courts, take them through courts, the process of appeal, and then deport them. I think that's a time-taking process. But there is very likely to be a slowdown in immigration. And I think that's easier to execute, which means that some of the growth surprises that the US was showing, which was coming from higher labor force or faster growth in labor force, will actually slow down. There is a second element, which is deregulation, which again is a lot easier to do because it's in government hands. So financial sector deregulation, oil drilling deregulation, healthcare deregulation, all of these will actually, I think, boost productivity growth potentially for the US. So on the fiscal side, the fact that he wants to extend tax cuts, meaning or rather the 2017 tax cuts which are expiring in 25, he wants them to be extended, will mean that the US economy gets some fiscal impulse, and that could also be a growth positive. So these are the various factors. In my view, net, given how he seems to be focused on the stock markets a lot more, I would think that any meaningful negatives on the economy side will actually not go through very quickly.
I want to continue with that point. President-elect Trump has continued to mention India and even Brazil with regard to tariffs. Do you see a shift required in our trade policy on this account, given that he's coming back to power and the likely consequences?
See, this is where I think many of the statements that we hear from the new administration in the US are starting points for a negotiation. And so even the threat of reciprocal tariffs, meaning that we will impose on import duties the same as what they impose on us, will mean that India may be among the worst affected, because India's import duties are among the highest among the major economies. We've calculated that if you just translation, it would be about $7.5, $7.6 billion in a year, which is not small, but again, not earth shattering. So, should India's trade policy be changing in anticipation? I think this will be a process of negotiation. Frankly, doing something in anticipation may not be necessary.
Absolutely. And there's quite a bit that is expected to happen in the coming months. And we will have to continue to keep track of all those developments. Separately, we know that there's a bit of a thaw that seems to be underway as far as India and China are concerned. And that could also have an impact on bilateral trade between the two countries in the larger mix of what to expect as far as India's and global growth is concerned. But Neelkanth Mishra, I want to thank you for taking out the time to walk us through the expectations for the Indian economy in 2025 and beyond. Thanks very much. With that, it's a wrap on this show. We'll be back with more. Until then, goodbye.